all right, everyone. How y'all doing? It's great to see all of y'all. Let's just say hi to everyone real quick. What's up, Hungry Queens? How you doing? What's up, Jesse? Good to see you, bro. Bull Runner, pleasure as always, man. Aaron, great to see you, man. Barb, great to see you. I see you've been winning lately, Barb. Good job, really good job. Geeky, what's up? Fecker, what's up? Cubanadian, how's it going? What's up, Adam? What's up, Kyle? All right, let's jump into this. So this stream's going to be a little different than all the other streams. This will probably get spliced up into smaller videos as well. But we're not going to break down the market at all. We're just going to teach you guys about market structure. So step one when you're trading market structure. All these 22 indicators that we have over here, we're not going to need any of those. So we can just right click and we can just remove all of those. Okay. Now, let's go over what we're going to go over today, okay? We're going to go over market structure, internal and external. We're going to go over supply and demand. We're going to go over order blocks. We're going to go over breaker blocks. We're going to go over liquidity sweeps, equal highs, equal lows. We're going to do some live trade setups. And we're going to go over volume confirmations and how to identify trades. So if you guys, this is your first time seeing me, my name is Market Cipher. I run a Discord that's focused on traders, helping traders learn how to trade. If you're not a member of the Discord, go ahead and join in the comment that's pinned to the top of the chat. And let's get started. Okay. So, first let's break down highs and lows. All right, so this is a general market cycle trend, right? So first thing you have to understand is, let's start at the very base level here, right? And that would be whether your market is making higher highs and higher lows, or whether your market is making lower highs and lower lows, right? This would be the basics of structure that everyone knows, right? Now, in a trend, you also have to understand whether your high is a weak high or a strong high, and whether your low is a weak low or a strong low, okay? So the easiest way to understand that is to understand what the job of a low or a high is, right? So the job of a high would be to break the low, and the job of a low would be to break the high. A low becomes a strong low if it is able to successfully complete its job, right? So if this is your price action here, the job of this low here, I have to add some stuff to the favorites here so this can go faster for you guys. The job of this low here was to break this high. So since this low was able to break this high, it is good at its job, it is strong. That is now a strong low. Now, we know the job of a high is to break the low, right? So if this high has failed to break this low, then this would be a weak high because it's not very good at its job, right? So this is very important to understand because if you are trading market structure, you want to understand that you want to have your stop losses behind a strong low, right? Now, or a strong high, right? Conversely. So let's do the inverse. And feel free to watch this on 2 times speed if you are a little bit faster if you're watching this back. So the job of this high, all of these highs were weak because they all failed to break the prior lows, right? The trend is making higher highs and higher lows. Right? So when do things change? Right? So things change. Why are these? Okay. So things change when your strong low is broken. Right? This is what we call a break of structure. Now we will get into more of that later, right? Or a change of character, sorry. This would be a change of character. So something has changed. We have gone from making higher highs and higher lows to making a lower low. So in market structure, this would be your first indication to pay attention because the trend may be changing. So once this happens, you have your change of character, break of structure, right? Once this happens, this high becomes a strong high. Right? And then as long as this high is not broken, this low would be a weak low. So that flips structure, right? So then if you're taking a short trade from the retest here, your stop loss would go above your strong high, right? To ride the trend down. So that's strong highs and strong lows. And higher highs and higher lows. Let's talk about internal versus external structure. Actually, let's go over the break of structure occurrences first. Okay. Okay. So, since we understand where our strong low would be, right? And where our weak high would be, we can understand that in an uptrend, when a weak high is broken, this was the prior structural high, the prior weak high. Should that structure break, we would call that a break of structure. When structure breaks, the game changes, right? Now we're trending higher. So this is a continuation signal. That also signals that whatever low that you just put in, because this was the prior strong low, whatever low that you just put in is the new strong low, because it did its job correctly of breaking the week high, the previous week high. This is called a break of structure. Yeah, sorry, not a stop loss, right? Strong low. So this is called a break of structure. Now, where else do we see break of structures on the way up? Let's mark those, right? So we have a break of structure here. And we have a break of structure here. And we have a break of structure here. Now, what's something that we notice in here, right? Well, one thing that we can notice is that there are ebbs and flows inside of our market structure, right? Now your structure is going to be your relevant highs and lows, right? Inside of these areas, we're seeing breaks of structure in the opposite direction, right? This is why it's important to understand the difference between internal structure versus external structure. This is where most people go wrong with market structure, and this is probably, well, everything's important, but this is one of the most important things when it comes to market structure. Right? So, if we know that this is our strong low and this is our strong high, any structural breaks that occur within these two areas, so all of these, would be considered internal internal structure, right? This is internal structure. Now, where would external structure be, right? External structure is the break of structures that we have marked out. That's all external structure. So, let's identify where a bearish break of internal structure would be. Well, the first one on this market cycle outline is right here. Right? This is a bearish break of internal structure because it's the first time that you have a lower high. Let's make this small. And let's signal that it's internal, right? And you have a lower low. Right? So your internal structure has flipped bearish because this is your high, this is your low, and all of this price action is internal to our core structure. Okay? Now, how can we use this? Why is this important? Well, this is important because you want to trade in the direction of the trend, and you want to enter the trade in the highest probability area where the price is likely to continue or resume the trend, right? We understand that these are impulse moves, and these are corrections. If you are in a trade, or if you are in a trend, sorry, you want to if you are in a trend, you want to trade the trend. Trade the impulse. You want to avoid the corrections because you will get chopped up in the corrections. They are not fun to trade. Right? So using our internal and external structure, we can understand that where in this correction does the internal structure flip back bullish in line with the external structure? Well, where do we make our first higher high? Right here, inside of the internal structure. So this would be a bullish break of structure after our bearish break of structure. Let me make a new label here. We can talk about change of characters for break structure later. Just understand that, yes, these are technically called a change of character, but to understand market structure right now, before we differentiate, you don't need to understand the difference, okay? This is when structure puts in its first higher high, out of this lower high and lower low structure, right? So that would be a good place to enter the trade because you can use so there's a couple ways to enter into a trend. So, right, like you can understand that you want to get in on the discount, right, for risk to reward purposes. And you want to put your stop loss behind your strong low. TP1 is the break of structure at the top of the range. Notice how that's a 4-to-1, right? And then you get a higher risk to reward back to the highs, right? That's why it's important to understand your strong lows, because your strong low is where you want to put your stop loss. Your strong low you can rely on. He's a good friend. Your strong low is like a friend who helps you move, right? Or helps you move your mother, right? A really good friend. So you want to put your strong low behind your reliable friend who's got your back. And the further that the price comes towards your friend, the higher your risk to reward is, the better the trade is, right? Now, you can help your risk to reward using internal structure within your trend, right? If you wait for this break of structure internally here, then you can use your lower time frame or internal structure break as your stop loss to hop on trend that way. We'll go over more of that later, but this is just important to understand that there's two general entry signals. When you get a desirable RR to your strong low or a break of structure internally within the trend, right? Okay, let's talk about the difference between a break of structure and a change of character. So a break of structure is continuation logic, right? Like when we see this break of structure here, we know that the trend is resuming to the upside and trying to push higher. And that we have just created a new strong low. So if we want to hop on trend on the break of structure, why is it doing this? My apologies, guys. We can now use that stop loss, that strong low for our stop loss, right? That newly created strong low. So it's a continuation indicator. A change of character, and let's just create that here so it's a little more easier for you guys. I'm going to turn off the music for now. Okay. Okay. Okay, so a change of character is going to be like the market yelling at you, hey, it's time to pay attention, something is changing. Right? What we would call a change of character would be the first time that the structure stops making higher highs and higher lows, right? So this is your last higher high. And then this is your first lower low. Now, why is this a change of character and not a break of structure? Because at this point, when this happens, you do not have any structure, right? This invalidates the bullish structure, but it does not establish bearish structure. It's a reversal sign. It's a time to pay attention because the trend is likely shifting. Now, why is it a change of character? Again, why is it a change of character and not a break of structure? That's because when this occurs, you have a lower low and a higher high. Now, what do you know about market structure? A downtrend is going to be making lower highs and lower lows, right? That would be a downtrend. An uptrend is going to be making higher highs and higher lows. So if you're making higher highs and lower lows, you're not trending. You're just no longer in a verified uptrend, right? So then the first break of structure after a change of character occurs when that lower low is then broken. Right? Because at this point, you're now making lower highs and lower lows. Right? So that's why it's important to understand a change of character and a break of structure, because this is your real confirmation that a downtrend is forming. That's why a lot of times retail traders will get trapped here. A lot of times they will get trapped at the change of character. A lot of times liquidity grabs will cause a change of character, only to then continue up and break the higher high structure. Right? Resuming the uptrend. Now, let's say that instead of what's shown here, let's say that from this change of character, the price comes up and breaks the previous high. Is this a change of character? No, this would be a break of structure because you're breaking your previous strong high. You're resuming the previous trend. If it came down here and then broke the high, then it'd be a change of character. Just a little side note there. Okay. So understanding that and understanding internal structure versus external structure, right? It's also important to understand that internal and external structure can also be represented by low time frame and high time frame structure. Right? Right? Let's make these teal. So there's structure going on within structure all the time. Why is that important, right? Well, that's important because you want to trade when your large time frame structure and your smaller time frame structure is aligned. So, for example, if you come to the chart, any chart that you're looking at, the first thing you should do is identify your environment. Right? If you start on your weekly time frame, and your weekly time frame is in an uptrend, but correcting. And your daily is in an uptrend, but correcting. And your 4-hour structure is in a downtrend. What do you think the best, highest probability win rate, highest RR trade in this situation is going to be? If anyone has the answer in chat, I'm going to grab a drink of water, put the answer in chat. I'll wait, guys. Someone's gotta have an idea. All right, Bull Runner's onto it. Why the 4-hour? All right, cool. Yeah, you guys have got it. Not exactly Bull Runner, but kind of. Yeah, Ficker, you got it right. So, yeah, Ficker's got it. Great job. So, in this situation, imagine that this downward teal line is the 4-hour structure, and this. So let's outline this. So this is your daily strong low. This is your daily weak high. And this is your 4-hour structure, or 4-hour downtrend. Your 4-hour downtrend structure is going to be internal structure on your daily. Now you can also have internal structure to that 4-hour structure, but it doesn't really matter right now, right? So this is your 4-hour downtrend. What is going to give you the highest RR into, so you understand that you're in a weekly uptrend, so the price is going to favor higher prices on a big zoomed out weekly time frame. So you want to participate in the weekly uptrend. You understand that your daily is in an uptrend, so on your midterm time frame, you want to participate in the uptrend so you can hold your trade for longer. And then your short-term time frame, which is your 4-hour, you're currently in a downtrend, so you don't really want to take an entry right now when it's in the downtrend because you're going to be sitting through the price going against you. And like, for example, this is a good time to talk about risk to reward. Okay, this number is going to be crazy because I just drew it in the middle of nowhere, right? But let's say it's a 50% stop loss here, right? I don't want to have a 50% stop loss. My risk to reward would not be very good, right? So let's identify this is your long term, mid-term, and short term, right? So the highest risk to reward in this setup is going to be when your short-term time frame flips from a downtrend to match the higher term time frames. When your 4-hour starts uptrending again. Why? Because then everything's in alignment. Your 4 hours in an uptrend, your daily's in an uptrend, and your weekly's in an uptrend. The price will most likely go up, right? Now, why is this important? Well, this is important because by using so this is like your long-term bias. This is your confirmation time frame, and this is your entry time frame, right? By using our entry time frame to determine when there is a bullish breakout or change of character, on our 4-hour time frame, we have just flipped it from needing to use our daily strong low as our stop loss to being able to use our 4-hour new strong low as a stop loss. And in doing so, we have greatly increased our likelihood that the price will resume going up immediately, and we have increased our likelihood, and we've reduced our risk. Instead of having the crazy 50% stop loss, right? You now have, all right, it would obviously be better than this, but we're dealing with millions of dollars in this example, so it's not. You have a 40% stop loss, which is better, right? But in practice, it's going to be a lot smaller than that. My bad oh, it's because I'm on log. Oh, wow. Yeah. Okay, but you get the point. You get the point. It increases your risk to reward, and it increases, and it reduces your risk. Or it increases your probability of winning, and it reduces your risk. So take a screenshot of this. That's why it's doing that with my positions, because I'm on log. Okay. This will be a better way to explain it. Let's say we just entered randomly somewhere on this pullback, right? What the? It's just disappearing. Okay. Oh, because I'm going to before this existed. Okay, let's try this. Okay. Okay, that's not going to work because of the way the percentages are. But yeah, your risk to reward is going to be higher or lower whenever you're entering like this versus a strong stop loss like this. So this would be your entry condition when you identify your environment. You look at your long term, your weeklies in an uptrend but correcting, your midterm, your dailies in an uptrend but correcting. You're looking to get in on your entry time frames, change of character. How does this translate down to the 15-minute and the 5-minute charts? Well, it's the exact same thing, right? So if you're trading on your 15-minute time frame, then you would imagine this is the same thing, right? So imagine instead of weekly here, it said like 1 hour time frame is in an uptrend but correcting. Your 30-minute time frame is in an uptrend but correcting, and your 10-minute time frame is in a downtrend. It's the same thing. You would just scale these up or down depending on what time frame you're trading. So you would always have a longer term time frame for bias, a midterm time frame for your trend, and then your short term time frame for your entry. Put a 1 in the chat if this made sense. Or ask any questions that you have. I'll wait for like a minute or so. See if you guys have any questions. All right, cool. How to front run the change of character. So that's something when we're going to go through some live examples later, and we can go over that. The way that you're going to front run a change of character is by using an even smaller time frame. Yeah, scale it to a lower time frame, yeah. So like, for example, imagine that this is still our trading environment, right? Obviously, the highest risk to reward would be if you manage to catch the the 1 minute downtrend change of character that ends up being the actual 1 minute downtrend change of character that results in this. Right? That would be insane. Then your risk to reward is going to be like 5,000 or something, right? So obviously you can front run higher structure with lower time frame structure, and that reduces your stop loss. So if you're entering the weekly trend at the exact 1 minute downtrend change of character that ends up being the bottom of that weekly correction, your risk to reward is going to be like 5,000. That is pretty hard to do though. But if you get really lucky, that would be how you can like get the highest risk to reward possible. It can happen though. It can happen if you're disciplined enough to hold a runner like that. Okay. You don't need a support and resistance, smart money, and so to understand these concepts, so in theory you wouldn't need that, but obviously the more confluences you can stack together to understand the likelihood of a change of character being the change of character that's going to result in the higher time frame shift goes up when you start using things like supply and demand, breaker blocks, order blocks, all of that stuff. So, which is actually what we're going to move on to next. So you do still need that stuff for confluence, but to understand and to execute this stuff, you don't need it. Like there's a world where you just use this stuff only and you can be a profitable trader for sure. If that makes sense. But there are other aspects of smart money concepts besides just higher highs and lower lows and structure breaks that we're going to go over now. But just to make sure that everybody understands where we're at, right? So this would be your external bearish change of character. This would be your external bearish break of structure. This would be your internal bullish shot. This would be your internal bullish break of structure. This would be your internal bearish chotch. And this would be the best entry. Into a short. It's not showing the right risk to reward here because we're in the millions, right? But this would be your your best risk to reward into the next leg of the downtrend, right? Same thing as here, but upside down. Okay. So we're not going to go over stuff like spider lines in this stream, Becker, just because we're focusing on market structure. Okay. So let's talk about supply and demand. So to understand the idea of supply and demand, you need to understand what previous trading ranges are, right? So this right here would be a previous trading range, right? This right here would be a previous trading range. I'm just grabbing two random ones so you guys can understand the idea, right? Now, what can we understand about this trading range here? If the market is moved by supply and demand, we can understand demand is where a lot of people want to buy the asset. Now, what happened after this trading range? The price went on a tear to the upside. There's a lot of demand to buy in this range, right? Now, what happened in this previous range? Or after this previous range? The price went on an impulsive move to the downside. There's a lot of supply in this range. A lot of people want to sell the asset in this range, right? So we can understand that in this range here, there's a lot of demand. And that in this range here, there's a lot of supply. Those are general ideas of supply and demand just by looking at a chart, right? You can understand if there's demand in a trading range just by understanding what the price did after it was in that trading range. Now, why do we care about that when it comes to market structure? So, if we're looking at our weekly here, if we understand that there's a lot of demand in this range, that means there's a lot of resting orders from people who didn't get filled in this range, and there's a lot of institutional interest in this range because they know that when the price was in this range before, it resulted in a major weekly impulse to the upside. If the price comes back to this range, it's more likely to repeat its memory and create an impulsive move to the upside again, right? And by coming back to the demand range, anyone who FOMO'd on the move up would be stopped out and then just to see it go up again, right? So it's a way of clearing liquidity in the books and engaging those previous orders from the demand range that results in a strong move up, right? So, for example, if we were to extend this range over, I don't want to pause all this. Okay. What do we notice whenever the price came into a previous area of demand? There was a strong bullish reaction off of that area. Now, if you are in my Discord or you've been following this channel, you'll know what RIMC is, right? That's range, initiation, mitigation, and continuation. Now, this is in market structure the ways that we generally understand a range to operate, right? The price will form a range. The price will initiate out of that range. The price will mitigate that range. And the price will continue out of that range if the current trend is going to continue, right? So this would be your range, your initiation, your mitigation, and your continuation. Right? Go ahead and take a screenshot of this. Right? Let me get rid of, or we can leave that there, that's fine. All right? Max, I have a market structure market structure indicator that I made that includes this stuff. So if you're looking for a market structure indicator, you can hit me up in Discord. Okay. Put a 1 if this makes sense, or if you have any questions about RIMC, go ahead and ask them now. Okay, awesome. So, let's talk about the same thing upside down. So, in this previous range that we were talking about, this area here, right, we identified that there was a lot of supply in this area that led to a bearish break of structure. Right? So should the price return to this area to mitigate it, we would expect a continuation to the downside. So in this instance, this would be your supply. And you'd be looking at range, initiation, mitigation, continuation. Upside down. Similarly to demand, we know that there's a lot of resting sell orders that didn't get triggered in this range. Everybody who FOMO'd short on the way down is getting stopped out on the way back up. Bulls are getting trapped into thinking the price is going to go up. And then ultimately the price reverses and comes down, right? So we can take this trading range and we can extend it across. And we can see that you had a 2.33 risk to reward if you went short on the mitigation back to the lows, and you can use your strong high as a stop loss guard, right? 2.6, right? So that would be a short entry out of supply. So demand equals where the price lifts from. Supply would be where the price dumps from. You could also go short on the continuation, right? So, yeah, so that's kind of what we were talking about earlier, right? So on the weekly chart, you could go long on this bullish break of structure using the new weekly strong low as your stop loss. And you would still be in that trade, right? And you could, and then after this break of structure here, right? After this break of structure, this becomes your new strong low here on the weekly, right? So you can then move your stop loss to underneath this low. And then after this break of structure, your stop loss would then be up here, which means that were you to get stopped out, you'd be up 54%. And you would just keep moving it with new break of structures, right? Okay. So yes, you can enter on break of structure continuations as well. Yes, so when the price creates a new strong low or strong high, depending on if you're an uptrend or downtrend, you would be moving your stop loss within to that new strong low or that new strong high. Now, understanding that in crypto, a lot of times if you're on a smaller time frame, that will be swept, like the strong low can get swept in SFP, right? So sometimes you can leave a little bit of room. You can use range deviations to do that as well, something that we'll go over later. But that's the basic idea of trailing your stop loss. And then before we move on to order blocks, does everybody put a 1 in the chat if you understand the idea of trading ranges either being supply or demand? Awesome. Love to see it, guys. Love to see it. Okay. Let's talk about order blocks. So, what is a order block? A order block would be, let's say you have a bearish candle followed by a bullish candle. An order block is created when a bearish candle is completely engulfed by a bullish candle. Now, what order blocks do we care about? We want to see what's called, what generally, or at least when I'm referring to them, are called OVIMs, right? This would be an order block that resulted in an imbalance of momentum, right? So if after this green candle there were 2 more green candles that came up and broke the prior structure, that's what we would consider a OVIM. Now, this is easier to teach in practice, right? So let's see what a good example of this would be. Let's go to like Solana. Something that interacts with order blocks a little better. Okay. So this is a good example right here, right? Okay. So this is a good example right here, right? So understanding it, it's important to understand that a bullish order block is going to be the last down candle before a big move up that's fully engulfed by a bullish candle, right? Down candle fully engulfed by a bullish candle. And you want to see it break structure. You want to see it break some sort of structure when it comes up and create an imbalance in momentum, right? The reason for this is because there's a lot of resting orders that didn't get filled down here that should the price come back down, it's going to pick up those orders, stop everyone out that FOMO'd before the price continues. There's a lot of institutional interest in this area. This is also what creates a breaker block, right? Why is it a breaker block? Because it broke the prior strong high, right? Or the prior structural high. So it's a breaker block because it broke structure. So if we were to mark this out, right, we notice that the price came down to the previous breaker block before continuing structure to the upside. Or sorry, there we go. right? Price came down to the previous order block before continuing to the upside. By looking at the reaction here, you can understand the value of these, right? Now, what order blocks do we generally want to look at? So generally, again, we want to look at order blocks that break structure, and we want to look at order blocks that occur in discount generally, which is going to be anywhere below the 0.5 fib, right? So we know there's an order block. So imagine this didn't SFP here, right? We know there's an order block right here, right below price, but that's way up here in premium, right? So we're not going to care about, or this order block here that didn't break anything. But for example, we wouldn't really want to look to that because the risk to reward's not there, right? Now this order block is way in demand down here, so we're going to care more about this order block because it's going to give us a higher risk to reward coming back up to the highs. So generally you want to focus on order blocks that are in the premium or discount of the range, depending on whether you're going long or short. Let's find some more examples here, right? So this would be an example of a bearish order block, right? There was a bearish break of structure resulting from this order block up here. So should price return to this area, we would expect there to be a bearish reaction out of that order block. Now it is crypto, so like it did get swept a little bit and closed below, but then you got this nice doji bearish move out of there, coming back down to the demand range before resuming move back to the upside. So this would be an example of a bearish order block, right? This created, wicked a new low, right? It's above the 0.5 range. Now the risk reward up here is great, right? So we would definitely look at that one. But that would be an example of a bearish order block. So it would be the last up candle that gets bearishly engulfed, or yeah, the last up candle before a down candle that bearishly engulfs it, right? For example, let's go to the SPX. Okay, here's an example here, for example. So let's see, where would that be? Be here. Right? We come down to this bullish order block, and it results in a bullish move to the upside. Now, okay, we have to go back a little bit because we have to revisit something with structure. So when we're understanding what constitutes as a low and a high in structure, we need to go over the 2-candle rule. Right? What is the 2-candle rule? It says that in order for something to be a valid high or a valid low, at some point in that move, in that leg up or down, there needs to be 2 consecutive candles. 2 candles closing in the same direction, with the second candle Some people don't follow that. So some people follow the rule where the second candle has to exceed, push in the same direction, so it has to exceed the price of the previous candle. Some people don't follow that rule. You can make that determination when you start doing your own market structure analysis. But basically, there has to be 2 bullish candles pushing in the same direction, or 2 bearish candles pushing in the same direction. What does that mean, right? So that means that this, for example, right here, where there's only 1 bullish candle here, this would not be considered a high, right? So your relevant high would still be back here, but these 2 downward candles do create a relevant low, right? For example, this 1 bearish candle here would not create a valid low. This candle would not create a valid low. This candle would not create a valid low. This candle would not create a valid low. This move down, if we check our checklist, we have 2 candles moving in the opposite direction, in the same direction, sorry, the downward direction. Only 1 candle moving up, so it doesn't establish a high. Moves down again. Moves up again. 2 candles move up, establishes a high. So we now have our low and our new high. Right? Before we go on, I wanted to go over that because you're not going to be able to identify break of structures or change of characters unless you're able to identify the 2 candle rule, 2 candle market structure. I kind of skipped over that earlier. That's my bad. But definitely you need to understand that. Okay, so a good example of how to use order blocks. For example, if we look at the macro, this is the best macro chart for Bitcoin. If we look at the macro relationship between Bitcoin and gold and do some market analysis here, let's apply some of the stuff that we've learned, right? So we know about trading ranges. We know that when a trading range results in a strong upward movement, that trading range becomes demand. From the supply and demand lesson, right? So this is our monthly trend on Bitcoin, right? So where should we be expecting the bullish momentum to come in? On a retest of that demand. Right? Because we have our range, our initiation, our mitigation, continuation, right? So by applying market structure ideas and supply and demand, you would have been able to buy the bottom of the bear market, right? Just by looking at this chart, understanding the trading range, you also would have been able to buy that summer dip. It doesn't look like it, but it did retest the highs here on smaller time frames. This chart behaves weird on larger time frames, but you would have been able to buy this mitigation, SFP, comes back down. You would have been able to buy the bottom of the bear market, right? Now let's apply what we know about order blocks. All right. So let's just start outlining some order blocks here. Okay. So we have a order block here. We have a order block here. We have an order block here. We have an order block here. Now, one more thing that we want to talk about with market structure is we're paying attention to areas that have not been mitigated yet. Remember? So mitigated means interacted with. So notice how these order blocks have not been touched by any other candle, right? Whereas this order block here has been touched by these other candles. So you could look at it still as like a supply zone, but in terms of like an OBIM, this would have been considered mitigated. Sometimes you can look at it as like, has it been mitigated after the break? But as a general rule, the strongest areas are going to be areas that have not been mitigated or interacted with any other candles, right? So let's apply our knowledge there. So for example, during that June of 2023 dump on Bitcoin, where it was making like equal highs on the USD chart, that doesn't really matter for learning, but like when we tapped this previous order block, bearish order block, we got a 20% correction. So you could have identified this as an area to go short. You know that you're just targeting a pullback, right? Or an area to take profit on longs, for example, because you have switched your weekly structure to bullish here. So you could have more used this as a target for longs, but you also see a bearish reaction there, right? This is just identifying areas where we can expect there to be a reaction, right? And for example, there's the other order block here. Well, what happened when we tapped that? Well, that was the 48K high or whatever before the ETF drop. So we can identify that as a target for longs too. Where did that drop to? This bullish order block here. This is a better example. So let's look at the long side. Well, they're all good examples, but you know what I mean. All right? Still in that trade now. 12 risk to reward by entering off the weekly order block. Called the exact bottom. For example, so back whenever we broke out of the 74K range, right? We broke out of the flag, right? We don't really care about patterns, right? But this is just an example, right? So once we broke out of that range and we broke structure to the upside, let's find an order block. Now, it might not look like much here, but the price went up like 5% out of that order block, swept the liquidity, and then went up like 16%, right? But for example, this order block, right, the last downward candle before the impulsive move up, right, would have given you the 74K bottom here. I should probably go back to the USD charts because I don't want you guys to get confused by this not being the Bitcoin chart, but by looking at this previous order block, this OBIM, right, that created the imbalance, you would have been able to buy that 74K bottom. Now this follows all of the rules of an order block. Right? It is the last bearish candle before a bullish candle fully engulfs it. It didn't interact with any other candle, and it resulted in an impulsive imbalance in momentum. So, should the price come back to that level, there would be a lot of institutional interest, and it's a good place to look for longs. Okay? Now, let's start looking at how we can combine all of this stuff into live trades, okay? Let's pull something random up here. Yeah, Django, what's up, man? What would give you the confidence just putting a order there after 6 months of price? Great question. Great question. So, let's talk about that. Let's stay here and combine our knowledge for a second. So what would tell me that we're going to get this reaction here? Well, what I can do is I can wait for confirmation. Now, knowing what we know about structure, now you could obviously reduce the time frame and find entries on lower structure, but let's just stick with this time frame for now. So if we're looking at our strong highs and strong lows, right? This was our previous structure before we came down there. Right? Then we 2 bullish candles in a row, we created a high, right? So this was our previous strong low. Farcoin, yeah, sure, Max. You can look at the Farcoin. This was our week high. Or I'm sorry, this was our previous week low. Strong high. Then we broke structure here bearishly. Creating another weak low. And then out of this order block, this demand order block, this bullish order block, we flipped daily structure. This was your confirmation. Now, just by looking at the chart, what do we see? What do we see happened right after we did that? The price went up only, right? I mean, you can see that by looking at it, right? So what does the trade look like when you're waiting for confirmation? So after we changed character here, remember, what was the job of this low? Now keep in mind, on the daily, all of this is internal structure. Now think back to the beginning, right? All of this is internal structure to this low and this high. This would be your weekly strong low and your weekly weak high. So this is exactly what we were talking about in the beginning of the stream, right? So this is your internal bullish chotch inside your trend when the daily aligns with the weekly again, right? Because throughout this entire dip down, we never lost our weekly strong low. The weekly is still in an uptrend. Excuse me, I'll blow my nose. The weekly is still in an uptrend, the daily's in a downtrend, right? So if we're using our 3 time frames, right, we can say the monthly's in an uptrend, the weekly's in an uptrend, the daily's in a downtrend. This is that location where the daily structure flips bullish again, aligning with your weekly and your monthly structure. So this area is when the monthly is bullish, the weekly is bullish, and the daily switches to bullish. Right, so your daily would be your entry time frame in this instance, and this is when you can enter with your stop loss below the low, targeting the previous highs. That's a 4-to-1 trade. So that would be when you can know to trust that, right? So if we're comparing that to, for example, what happened at this OBIM, so let's just remove all this. So if we're comparing that, for example, to what happened here, how did we know we could trust this one, but we didn't know we could trust this one? Well, where was our previous low, right? So we had our bearish break of structure here. We created a high here, 2 green candles. The difference when we came down to this order block is that we did not break structure. We formed a lower high. Where did we form that lower high at? Well, interestingly enough, we formed that lower high at a bearish OBIM. So, at this point, the RR was actually in favor of this trade, which was a 5 risk to reward to the lows, which worked out. Because if this level broke, we would expect the same thing that happened here. A flip in bullish momentum. If this level holds, we would expect this strong high to attack the weak low. Does that make sense? Put a 1 in chat if that makes sense. This stream is a little messy. We'll probably redo this one day, but you guys get the point. All right. Let's talk about SFPs. So, an SFP is a swing failure pattern. So first we're going to talk about just SFPs as most people understand them, right? So, for example, understanding what we understand about structure, right? We had this week high on the weekly before all this price action was here. 2 bearish candles created a strong low since it did not attack the previous low. Now, when we come up to attack this week high, and we come above the high and close back below, this is what we would call a swing failure pattern. So this week high was strong. It did its job. It held price. And we would then expect price to come attack the strong low. Because this, remember what we talk about with strong lows, right? What was the job of this low? The job of this low was to take out this high. Whenever this low fails its job, it's like your friend who helps you move, right? You got the moving truck at your house, right? You have all your boxes out. You start moving your boxes in, and then your friend just drops all your boxes and they break, and you're sad. Right? At that point, before you hand your friend another box, you're going to go test him. You're going to see if he's reliable. Right? So, after this strong low lets you down and fails to make a new high, you're going to go test that strong low. Right? And then if that strong low breaks, internally this becomes a strong high. No, sorry. Yeah, so just understand this becomes a strong high. It is external because you created a new structure, but it's still internal to this move. But that doesn't really matter. You just need to understand that this becomes a strong high. Right? Because what was the job of this high? To break the low. If a weak high is SFP'd, the weak high becomes strong. Yes, exactly, right? Because what was the job of this high? It was to attack the low. So whenever it holds price and attacks the low, once that low breaks, it did its job and it becomes strong. This example can be a little bit confusing with external and internal just because of it being the weekly chart on Bitcoin, but that's the basic idea, right? The best way to understand it is to understand what I was saying about like what is the job of this strong high or the strong low, or the job of this high or low. So how can we understand SFPs, right? Do you guys see any other SFPs on this chart? Looking at it, there's like 4 of them. Can you guys point out any other SFPs you see? Sorry, 3 of them. The low, right? Yep, Django. Yep, Barb. Exactly. So we have two up candles here. So this is a valid high. We have 2 down candles, consecutive. Remember, they have to be consecutive. 2 consecutive down candles here. So this is a valid low. right? So the price comes down, sweeps the low, and closes higher. Bullish engulf, right? Strength. So what happens next? Well, hey, bro, what the hell? You dropped the box, man. Let's make sure you're strong. This is why you'll see in a lot of my calls, right? I talk about how much I love this pattern. An SFP followed by a break of structure. You can now put your stop loss above that or below that SFP low. First TP, range highs. That's where people took profit. Next TPs, maybe some fib levels, whatever you're looking at on the way up, right? But it's understanding that this is appealing because the low is going to be pretty close to the previous low, and it results in a break of structure. You can now put your stop loss below that low. Okay, so I know you guys probably have some questions, or might have some questions about SFPs. Is there any questions? Or put a 1 if you guys are good. Well, if you have any questions, somebody else probably has the same question, Bull Runner, so you can ask. Let's go apply all of this stuff as well. Throw some assets in the chat. Let's take a look. All right. Sure. Ideally, assets that look better than this one, but we can look at this one. So SFP stuff we were just talking about, right? 2 candles form a high, low, SFP. Break of structure. Enter, stop loss below the low. Looking to ride it up to the highs. 4-to-1 risk to reward. You can leave a runner on that trade, catch the bottom, right? There's the SFP application we were just talking about. All right, what else can we apply? Out of everything we've gone over, what do you guys notice here that could have been used on this asset? Let me just ask you guys. What do you guys see here? Demand. Yeah, exactly. Right? What did we talk about? This is a range where the price had an impulsive move out of it. This would be our demand range. All right. So if we then mark our demand, it also resulted in a weekly break of structure up here, right? So if we're using multi-time frame analysis, we'll know our weekly is bullish and our daily is internally bearish, looking to correct, right? But we'll go over how we got in after we understand what we're looking at, right? So we have a bullish range. We have our demand range. We have our range, initiation, mitigation, hopefully continuation, right? So let's talk about entry conditions. So we would have an alert at this area here to tell us to pay attention, right? Now, you could also have a lazy trade, right? Using the new strong low, targeting the highs. It's a 5-to-1 trade, you know? If you're not really looking to pay attention all the time to the market, a lot of swing traders use this strategy, right? And if your R to R is there, you take the trade. 5.28 RR. Right now, you would be up 3-to-1, holding out for your 5-to-1 trade, right? You could do that. You can certainly do that. And as we go through these examples, I'm sure you guys will see that over and over again. But so we know that our weekly flipped bullish here, right? Our daily flipped bullish here. So we know that our weekly and our daily are bullish. Now during this correction, our 4-hour is in a downtrend, right? 4-hour broke bearish here and has continued breaking structure down. Now, what do we notice? Out of this demand, we come up and we break our external, right? Because we broke the low. And then we come up and broke. What high led to this low? This high led to this low. So our external 4-hour market structure, our 4 hours correcting. All right, so let's go back to what we talked about in the beginning, right? So weekly is bullish. Daily is bullish. 4-hour is in a downtrend. All right, so our entry condition is going to be when the 4-hour change of character occurs. Now, this might just stay in a downtrend the whole way. Yeah, it did. So it didn't fake you out. Nice. But generally, stacking confluences like this key demand range is going to help protect you from fake outs. But this one didn't fake you out anyway, so it doesn't matter. But once we come up and flip our change of character on our 4-hour, we can take the trade. If our RR is there, right? Back to the highs. And what do we notice? We notice that our risk to reward goes from a 5 to an 8. This is what I was talking about earlier when we were going over like that the risk to reward would be better when you combine multiple time frame analysis by instead of just setting a resting order at our demand zone, but waiting for our confirmation time frame to break structure, we have switched our trade from a 5 risk to reward to an 8 risk to reward with our stop loss underneath that 4-hour low. Does that make sense? Put a 1 in the chat if that makes sense. Awesome. All right. This has been in a uptrend. There's not really external structure on the weekly because there was no lows in this move up, but it's in an upward move, right? What is one thing that you guys identify on this chart? Starting with our weekly. Are there any areas of interest that the price has reacted with? So when we just looked at our weekly, we can see our previous demand range here, right? Resulted in a previous strong move up. We come down to mitigate that range. What are we looking for on our entry condition? We're looking for internal structure to match up with external structure, right? Where is the first time our internal structure breaks bullish, right? Looking structurally. We have our price in a downtrend after this low is lost on the daily, right? Internal to our weekly structure, our daily breaks bearish here. 2 candles puts in a valid high, low here because 2 candles, right? There's no consecutive 2 green candles anywhere in here, right? So our next low on structurally would be here. 2 bearish candles puts in a low. 1 bullish candle, this high is not structure. Comes down, puts in a low. 2 candles, forms a high. Breaks structure here. Right? Entry condition, find our break of structure. Can enter off that break of structure. Stop loss below the lows, targeting the highs. It's a 15-to-1 trade. All right. Off of our supply and demand concepts, we also have the concept of SFP, break of structure, right? Because it's low. Got SFP'd as well. You could have got in on the SFP low as well. Targets the strong high. Breaks the strong high. This low becomes a strong low. You can use it for our stop loss, 15-to-1 trade to the upside. Cool. So that's how we can apply our SFP concepts and our demand range concepts. But what's something else that we notice here? Is there any order blocks on the daily? So let's take our 0.5 area on our weekly range. So we know we're interested in order blocks that are in discount of the range underneath the 0.5 that haven't been mitigated or interacted with at all. So is there any areas of interest here? Order block on the left, yeah. Exactly, Barb. We have an untapped, unmitigated bullish order block right here. So let's mark that out. So if we take our order block, so again, some people will take the more hands-off approach on looking for entries. They're looking for reactions and just rely on their risk to reward, right? 40 risk to reward trade? Oh, heck yeah, dude. I'll take that. Leave that. See what happens, right? But by applying what we know about order blocks, we're able to identify that on the daily time frame, this is going to be an area of interest. So what would we do? We would set a horizontal array at the top here, right? We'd set an alarm, and we'd be like, Varcoin hitting daily bullish OBIM. Right? Price comes down. So we have our weekly structure being bullish, and let's say we're confirming on the 4-hour, right? Price comes down. What are we looking for? We're looking for a break of structure. So we have our structure here. Four-hour structure breaks here. Now you can also go by internal structure breaks. So if we're looking at, so this would be kind of the same trade as the daily one we were just looking at. But if we're looking at our 4-hour internal structure, since it is a key area, right? We can see we have a 4-hour structure break here. Why is this not a structure break? Because there's not 2 consecutive candles to the downside after these 2 up candles, so this is not a relevant high, right? So there's 2 up candles here, 2 down candles, so this would be your high. So if we took our trade there, it would be slightly better than previous candle. 25 risk to reward, right? Versus if we just left it resting here and put our stop loss below here. It's like a little bit better, right? But if you put your stop loss just underneath the order block, you schooled everyone, right? But again, you want to protect your stop loss with strong lows. Some people do just use the order block because they're like, if the order block's mitigated, I don't want to be in the trade. It's one way to do it, but it's safer to just put your stop loss below the strong low, especially when you're this far into discount of the range, targeting the highs, right? Now, if you like trading altcoins, as you guys move on and go on to apply this stuff, you guys are going to notice how easy it is to trade altcoins using market structure concepts. So let's go to like Chill Guy, for example. Oh, this is futures. I was wondering where the data was from. Okay, there we go. No, that's the same. Let's grab something else. So let's say during this dump, right, we were looking at 4-hour market structure. So where do we break 4-hour market structure? Well, we break 4-hour market structure, putting in a low, come up, put in a lower low, come up, break that high. We break 4-hour market structure here, bullish. External market structure, right? Because we took out the previous low, we SFP'd it using your SFP break of structure logic as well. You could have entered off that. Stop loss below the low. Targeting the high. 5-to-1 trade, right? What else do we know? We could have looked for order block after this break, right? What do we notice? previous demand. Right, multiple chances to get in off that. Over here, over here. Trying to see if there were any order blocks in smaller time frames. Oh man. Yeah, this is the kind of stuff I'm looking for. So you break structure, you're zooming in on your time frames, you find out there's a 1 hour order block here. Boom. So notice how we broke structure on the 4 hour, right? And then we zoomed in on our lower time frames. Is there any order blocks on the 3 hour? No, none of these really bullish engulfed. Okay, this one's too high in the range. It's in premium. Is there anything on the 2 hour here? No, nothing really got bullish engulfed. Well, there's this one, right? So you could have looked, but this has already been tested, right? So we wouldn't look at this. After the break, this had already been tested. This is too high up in the range, right? This didn't break anything, right? Structure didn't get braked. Didn't break, right? Because this SFP'd. What about the 1 hour? Yeah, we do, right? This did result in the break of the 4 hour structure. It hasn't interacted with any other candles. It hasn't been mitigated yet. So what happens? You come down. You mitigate that order block. Now, this is where it gets crazy, right? This is the kind of stuff I was talking about. Already to where the price is now, that's been a 45 risk to reward, right? But if you're expecting Chill Guy to come back to the highs, which I don't know if it will, right? It's a shitcoin. But, for example, if it were to come back to the highs, that'd be like an 830 to 1 trade, right? 4% risk for a huge upside, right? But just to like the weekly previous high, if we're being more like down to earth, right? That was like a 40, like a 34 risk to reward, right? Now, let's zoom out. So, let's look at weekly structure. We put in a high here. This does not count as a low because it's only one consecutive candle. 2 consecutive candles, we put in our low here. High, low. We break structure here on the weekly. This range becomes demand. So if you got a 4 hour break of structure here, we could have gotten in off the weekly demand. Make sure your RR is there. All right, 5 risk to reward trade. Nice. What else do we notice on the weekly? Well, we have a nice order block down here. So maybe you can get lucky and get a trade down here. It might be worth setting this alert on your chart, right? That's not a bad trade if we come back down here. 80% move off that previous demand. Not bad. Yeah, this can be used with spot for sure. But you can also use leverage as long as you're, like, leverage is a tool, right? So as long as you're using it to, you're making sure that you have enough room for your stop loss and you're managing your risk. Okay, let's look at some of the assets you guys posted. You guys wanted, did we already look at Farcoin? Man, I don't even remember. I think we did, yeah. Yeah, we did. Well, Sol, yeah, we can look at Sol. Oh, wait, I used this one, okay. Last cycle, right? This would be a valid low, make a new high, break structure. This range is now supply. RR is not there on this trade, even though it's a win, right? So, what do we look for? Oh, hey, look, there's an order block here. Two risk to reward there. You could have taken that trade. All right, let's look at the bullish stuff. Right? This was like a bear market entry on the daily, right? Previous demands. What else do we notice, right? We don't care about this order block, right? Because it's not in discount of the range. Where's the first order block that's in discount of the range? Well, it's down here at $13. Right? And what do you know? That's where we bounced from. The risk to reward there was probably really insane. I mean, if you trade like with the order block as your stop, it's going to be completely ridiculous. Right? 400 risk to reward so far, but of course, I mean, to previous all-time high, it was 720 risk to reward trade, right? Nice. But I teach you guys to use the strong low. Still a 45 risk to reward trade, right? And you would look at entry criteria on the smaller time frame the exact same way that you look at this here. Order block versus order block imbalances. So an order block imbalance, so you want to make sure that the order block resulted in a break of structure out of it, right? And you also want to make sure the order block is underneath the 0.5 fib. Okay, let's look at like more recent stuff. Let's talk about decision blocks. Okay? So when you have a macro range, or just a range in general, or let's talk about decision demand rather. Decision demand is going to be the range that forms that results in the range breaking to the upside, right? So in this case, within this range, where is your decision demand? Your decision demand is here. This was the consolidation range that resulted in the move to the upside. Generally, during mitigation, you're going to come down and mitigate at your decision demand. Right? So if you were taking a trade here, your RR's there, 3-1, then you can take this trade. Right? And by using lower time frame confirmations, you could have found a way to like use your stop here. Maybe your entry was like here, right? And you can obviously scale your risk to reward by how much you're willing to zoom in, right? But if you're just lazy, set it and forget it, right? 3 risk to reward there. Same thing inversely. You want to be trading with the trend, of course, right? Your higher time frame trends. But just for the understanding the concept, range, decision supply, right? Could have taken a short off the decision supply here. Back to this accumulation model decision demand, right? Back up. Right? You can kind of make a map for price that way. All right, let's zoom in. Let's see what's happening right now. So let's look for trades. Let's look for our bias time frame to be our 4-hour, our 1-hour time frame be our trend, and our 15-minute entry. So what is our current 4-hour structure? This was our 4-hour low. We're trying to break that 4-hour low now. Okay, for the sake of this, let's do 1-hour bias. Let's do 15-minute, or sorry, let's do, 15-minute trends. And let's do 5-minute entries. It's a little cleaner right now. Or wait, sorry. Yeah, there we go. So let's look at our 1 hour. So what is our current 1-hour trend? So we broke bearishly on the 1 hour here. Came down, put another high, broke bearishly. Bearish, bearish. Broke bullishly here. And we just broke bearishly again when this low was broken. SFP, SFP, break. There's your break. Okay, so we broke our 1 hour bearishly here, so let's look at our 15-minute. So after that bearish break on our 1 hour, we know our 15-minute broke bullishly here internally, right? Puts in a low, puts in another high, and our 15-minute broke bearishly here. Let's look at our 5-minute. And then after our 15-minute broke bearishly, five-minute broke bullishly here. Man, this is a messy chart. Why is there so many gaps in this? Let's say we had a 5-minute bear break. If there weren't gaps, it'd probably be like right here. So if we have the RR from our bearish order block here, or bearish supply here, we could have like looked to take this trade. Right. Another way we could have done this, that was a little confusing. This chart's not very good on the 5-minute. Let's go back to the 15-minute. Another way we could have done this, if we know our 1 hour is bearish and we're forming this uptrend here, our 15-minute breaks bearish right here. We could have taken this trade. We know we're going to take profit 1 here. Because of demand, right? And we can trail our stop loss behind 15-minute structure. So whenever we put in a new 15-minute high here, we could have moved our stop down here and we would have been stopped out, right? Or you can let your RR play out down to the lows, right? But if you want to trail your stop loss whenever you create a new high, that's where you'd move your stop to. You would get stopped out. Like yeah, if your RR is not there, you can let it play out, especially since you're trading with your larger time frame biases. But for example, that would be like when your 15-minute aligns with your 1 hour bearishly. Okay, let me see if there's anything else I wanted to go over. Okay, we've been live for 2 hours. That was a lot of info. I'm sure you guys are probably going to have to watch some of that back. If you guys have any questions, feel free to put them in the Discord. If you're not a part of the Discord, make sure you join the Discord. I also have a market structure indicator. If you guys are interested in that, hit me up on Discord. Make sure if you're new here, subscribe, ring the bell. And if you guys liked this stream, let me know in the comments so I can maybe make some more like longer lessons like this. I don't want to overload you guys today. Let me know if you liked it in the comments below. My name is Market Cipher. Trade safe, guys. Much love. Market Cipher out.